Well, good afternoon, everybody. Thank you for joining our Lunch and Learn today. Hopefully, we'll bring you a couple of ideas that you can use, as well as challenge you to think of some things differently than the way you've thought of them in the past. And the reason I say that is the first one I'm going to talk about is mech versus non-mech, because the insurance carriers have done a very good job of convincing us that non-mech is good and mech is bad. And for the individual policy owners, that's probably true because of the difference in taxation. We'll go there. But I'm going to show you somewhere where maybe it's not so bad. So first of all, by a show of hands, let's see who all sells annuities. Okay. So let's talk about how annuities are taxed today. If you have a deferred annuity with an individual owner, there is no taxation until the money is taken out, either by withdrawal or death. If it's taken out prior to age 59 and a half, there is a 10% premature withdrawal penalty. That is pretty much identical to how a mech is taxed. Everybody agree with that? That's pretty much
Sure.
the same thing. So if you have a mech contract owned by an individual, interest comes out first, and if they do it before 59 and a half, there's the 10% premature withdrawal penalty. So those two are basically the same thing for an individual owner. So why do people buy annuities? Typically, they buy it with their quote unquote safe money. All right. And they buy indexed annuities because how many of you have heard the phrase zero is your hero? Meaning with indexed annuities, there's no way to go below zero on the crediting rate, but they do get to participate in the growth of an index, most normally the S&P 500, up to some cap limit. Okay? Now, so we've talked about annuities and why people buy them, but what about corporations? Can corporations buy annuities?
Yep.
They can, but why don't they? Because with corporations, the growth is taxed annually. Okay. Now it becomes like a CD. So, with that in mind, where do corporations place their quote unquote safe money that's on the books of the corporation? They really have limited choices, especially if they have to have it for a surety bond. I don't know how many of you are attached to P&C agencies that have a surety department, but if you have a surety bond, they cannot use any kind of account that can fluctuate and go below the balance that was stated on their financial statement. So they can't get into variable annuities, they can't buy VULs, they can't do anything with that money. They have to have that with the principal is guaranteed. So that limits them to possibly a CD, possibly money market, or our alternative. What about a cash value life insurance policy with an IUL? Now, does anybody want to guess how a MEC is taxed for a corporation? It's still tax deferred, isn't it? What about a premature withdrawal penalty? How many of you think there's a premature withdrawal penalty? It's not one for a corporation owned policy.
Oh, and
Okay. So, as far as I can think, and there might be some others, But this is the only thing that a corporation could buy where they have a guarantee of principal, but they have some opportunity to participate in the market gains out there. And they also have the tax deferral of the growth. As we all know, also, if it's ever paid as a death benefit on the insured, the corporation most likely is going to get the proceeds on an income tax free basis. There's some exceptions, but we're not going to go into that. It's a little beyond this uh, conversation. So,
Did you
with
say
that in
the
mind,
did you say the corporation like they have to I thought you said they have to pay taxes on an annual basis on the grant
on
on
annuities,
annuities.
not
Okay.
on life insurance.
Okay, got
So
it.
it retains the same taxation as an individual contract, except there's no 10% premature withdrawal penalty. Okay. So what I have done here is I've used a nationwide product. All of them are going to have these. They have a lot of the companies have what they call surrender value enhancement riders or waiver of surrender charges. They go by a number of names. But in this particular instance, you put in $100,000 and the net surrender value at the end of year one is $100,000. So there's no risk to the company. Year five, it's grown to 115. Year 10, it's grown to 146. Now, what companies might be interested in this? There are companies out there that are required to hold large cash balances on their in their accounts, particularly construction companies and auto dealers. Auto dealers for their floor plans, contractors for their surety bonds. Okay, we're going to talk about why they're easy to find and why you're not going to run into much competition here. But another benefit is if they're buying key person insurance for some of their top people, they're already spending money for life insurance. I'm going to go down here and show you what the cost of insurance. Now, if we look at this, the net amount at risk is $150,000. Okay, $100,000 of cash, $250,000 death benefit. This is on a 50-year-old male, I believe I said. So $150,000 net at risk. Look at the insurance charges in year one. Cost of insurance, $68. I don't think you can find term insurance, $150,000 coverage for anybody for $68 a year. Okay.
Huh. Okay.
So again, we go back to the illustration, and they are guaranteed this $100,000 at the end of year one. So now they can use this on their balance sheet for collateral against the for the floor financing or for surety bonds or whatever. If they cancel it at age 65 on this particular individual and they get back $200,000 and they put in 100, the corporation is going to pay gain tax on the $100,000 gain. There is no additional 10% premature withdrawal penalty. Now, so if you know people, or I know some of you on the call are attached to P&C agencies, if you have a surety bond department, you need to be talking to them and saying, because guess what? They have the balance sheets of the corporations. If they're going to write a surety bond, they're going to have a balance sheet. You can look at the balance sheet and find out who's got cash on the books. And where else are they going to put it? Can you sell this versus a CD or versus a money market? It's liquid, right? You cancel in 5 years, you get back $115,000, about a 3% return. But that's based on a crediting rate now at 6.59%. If the caps are 10 or 11, these numbers are going to be much higher in the good years. So the corporation gets to play in the market, but they have no risk. Zero is their hero.
Hmm.
Okay. Now, so we talk about where we're going to find these. We're going to talk, if you're not in a PNC agency and you don't have that surety bond division, you might be talking to your local PNC agent and seeing if you can't talk to them about this idea and say, let's share and let me show you how this is going to work for your clients. Okay, you're going to bring something to the table. The other thing that I mentioned is that you're not going to have a lot of competition out there asking for this or promoting this. And why is that? Well, there are a couple of reasons. First of all, as I said, the insurance companies have convinced us that mechs are bad. It's just like anything else. There are very few things that are 100% black and white. There's always an application for something. Here's the application for a mech contract. The second thing is, and I know that we have some friends on the call that are old line par whole life companies, but those companies like Northwestern, Mass Mutual, New York Life, technically, the agents are not allowed to sell index universal life. This concept's not going to work as well with whole life. It may work, but it's not going to work quite as well as whole life. So if you talk about that, you've gotten rid of all your local Northwestern, Mass Mutual, New York Life, Guardian agents who can't sell this product. I hope I didn't offend anybody, any of my Northwestern friends. I still love you. I just know you can't sell that product. I guess technically you can't sell that product, I'll say. So, with that said, again, we go down here and look, and I even have one. Let me see. I'm going to show you one. It's even better. That in 5 years they got $119,000 of cash value. But this one has a little bit, even a different rider with Nationwide, and on this one they reduced the percent of premium charge to 2% instead of 8%. So even if you add up all the expenses, what is that, about $4,000, and you get credited at 6.59%, you don't even need that rider to be 100,000. You're gonna have $102,000 of cash value. Okay. Now, this one affects your commission a little bit. But the other thing is, how much are you going to make on that $100,000? Well, the target's about 7,000. So whatever your rate is times the target of 7,000, plus you're going to get paid on the excess. And I believe Nationwide, if I am not mistaken, is 2% on the next $93,000. So that's going to be about an $8,000 or $10,000 deal for you. Now, I'm going to stop here and ask if I've changed anybody's mind about avoiding mech at all costs.
Yep.
Okay. What questions do you have on this one? Any questions? I'll go back, touch on another thing we really didn't talk much about, but this also could be used for key man coverage, as I said, because you might not, I mean, if you find a corporation that has $1 million they want to do something with, you'll probably need to spread that risk over 4 or 5 different lives and get a lower death benefit. Okay. And of this, the corporation can have it returned back to them as a death benefit. They can split it with the beneficiaries of the employee. There are any number of ways to design this to use that extra $200,000 of death benefit without the corporation having to give up any control or any liens on the cash value. Again, as long and like I said, in just about every situation, that death benefit is going to be tax free to the company. Other questions?
I have a question, Ralph.
Yes, sir.
What would be the thought process behind most insurance companies not providing this type of information and steering away from MEC, other than they don't know the strategy that you just presented?
That's a good question, Reynard. I don't know. Um, I have only heard of one company, and I'll be honest, this wasn't my idea. I got it from an insurance company, but it's the only one I have heard say anything about it. And I don't know why they avoid that. You know, I don't know how long you've been in the business, Reynard, but I go back a long time, and this whole thing about having some proportion between the premiums paid and the death benefit goes back to 1982, where the IRS would come in and try to make a regulation on how much that ratio had to be, and then the insurance companies got around that, made some modifications. So it's been a kind of a cat and mouse game for 30 years, 30 to 40 years about how to keep companies and corporations and individuals from accumulating cash value in a life insurance contract on a tax deferred basis and then having it get paid out as a tax free death benefit. So I don't know if that is some of the reason the insurance companies don't want to flaunt that or not, but that would be my only guess, and that's kind of reaching for straws. But there's, I mean, we're playing by the rules. You know, the death benefit that I calculated was the minimum guideline premium test death benefit. Okay, so. You know, that's all I can say is I just know that to me this has worked. This works, and if we talk about these businesses, let me go back and say one other thing too. The business owners are mostly risk takers. You don't find many risk averse business owners. There's some, but if you can talk to them, say, okay, I can guarantee you that you're going to get your money back in a year, or it might even be possible it'd be 105, $106,000 if the S&P 500 grows by 15%. Are you willing to take that risk, Renard? A lot of them will. A lot of them will. And to be better than a CD or better than an indexed annuity, I say you got to have about 3 out of 4 years to be positive on the S&P 500 to be ahead of the game. And if you look, it's another interesting fact, and they don't talk much about this. You can go back and look in the history of the S&P. If you take 1231 over 1231, there, I would say out of 75 years, there are probably only about 6 or 8 years where the growth in the S&P 500 has been between 0 and 10%. It's either negative, or it's usually very large. One of the two. Very seldom is it between 0 and 10. Somebody can fact check me on that, but I think it's like 8 years out of 75 or something.
That's interesting.
Okay, so I hope that makes you rethink MEC. MEC now for individuals, I'd still try to stay away from MEC because of that premature withdrawal penalty, unless they're already 55 plus. Then it's not a big deal. But if you're going to do this, one of the things I want to go back and we talked about, it's probably been a few months ago, is the Conley decision on buy-sell agreements. If you still have people out there that have buy-sell agreements that are entity purchase agreements, they need to be reviewed. I'm not saying that every entity purchase agreement is a problem. It's only going to be those that have a taxable estate. Taxable estate is about $30 million for a married couple, $15 million for a single. Because the Conley decision says if they have an ownership interest in the business and that death benefit is paid into the business to redeem shares, that value is includable in the estate of the decedent. So everybody's gone to cross purchases now, mostly. But again, it's only for the large estates. But at least it gives you a reason to go back and talk to your clients about their buy-sell agreements. And the opening line is, go to the client and say, are you aware there have been some changes in buy-sell agreements? If you haven't reviewed your agreement in the last 2 or 3 years, it's an opportune time to do it. If you'll let me look at it, I can give you some direction. And you're just looking for, entity purchase rather than cross sell or cross purchase. Now, on all of this, though, this is an IRS form that I have pulled up here. It's Form I-8925. And it says that every corporation has to report the contracts that they have on employees. They have to do this annually. First of all, you're supposed to get a permission from the employee for the corporation be owner and beneficiary of a policy on their life. And secondly, you have to file this form. You talk to some CPAs, they're not even aware that this form exists. Okay. Secondly, I've looked, I have not found anywhere as to how to remedy a policy if it was bought 2 or 3 years ago and this form has not been filed. Okay. I hate to throw scare tactics at people, but it's a good door opener with CPAs to ask them, if you know what a Form 8925 is, and are they filing it for their clients?
In lack of a cure, what would be the consequences for that?
I think this is my opinion. I'm not an attorney, but I did stay at a Holiday Express last week. I would think that it might create a taxable death benefit situation. Don't know that for sure, but that would be the concern I would have. Okay, so those are two of our topics. We wanted to talk about MEC contracts, and we wanted to talk about the Connolly decision and corporate-owned life insurance. Now, let's see. I'm going to go to one other thing. Let me see if I can find it. The one other thing we were going to talk about was loan rescue. So, let me see here. I think all right. Okay. Here we go. So, loan rescue is still alive and well. Okay. Everybody has policyholders who somewhere along the line have borrowed money against their policy and they don't know how to repay it. And you can roll those over to an index universal life policy. And the reason I say that is because most of the universal life policies have a participating loan feature, meaning they're going to charge you 5% on the loan, but you still have that money that has access to earning up to the cap rate. Okay, possibly 10, 11%. So that could turn into positive arbitrage. Okay, whereas on a traditional policy, the loan rate's going to be 5 or so, and they're going to credit you maybe 4. You're really paying a 1% loan interest charge on old policy loans. Where new policies, this gives you the opportunity to earn greater than the loan. And I apologize, I did not check with Nationwide, but I know, for example, with Prudential, on this one, I did a $75,000 rollover with a carryover loan of $30,000. Prudential pays you commissions on the full $75,000, not the net 45 that comes over. A couple of companies do that, but I'm not sure about Nationwide. I apologize, I did not ask. I've not asked. But the purpose of this, what I want to show you, is once you roll the money over, use any incoming dollars into the contract as loan repayment versus loan interest instead of premium payment. So if you look on the right, I'm sorry, on the left, here's the paying the $1,000 annual premium on this one. I just did a $250,000 death benefit on this 50-year-old. Had a $75,000 gross cash value with a $30,000 loan. So $45,000 net came over. He pays $1,000 a year for 10 years. The current cash value at the end of 10 years would be $58,418. Does everybody see that? That's on the left. The death benefit is 203. On the right side is if you make a loan repayment of $1,000. The cash value is now $60,000. Not a big difference, $2,000. The difference in the death benefit, though, is $13,000. Okay. Now, let's go to 20 years. If you go to 20 years, the cash value is 105 versus 113. Again, not a huge difference. But now let's look at what the death benefit difference is doing. 177 versus 210. Why does this work? Well, there's two reasons. First of all, when the money goes in as premium, guess what happens? Goes through a premium load. If you're paying for a repayment of loan payment, it goes in dollar for dollar into the cash value. That's the good. I'm always going to tell you the bad with the good. I'm not going to sugarcoat anything. You lose your renewal commissions on that $1,000 stream of money. That's one of the reasons it makes it work. Okay, does that make sense? Over here on the left is premium. You get your 2% renewal premium or whatever it is on the IUL. Over here is 0 because it's not really premium. Client's still paying the same thing, but they get a better deal because the death benefit doesn't go down as quickly as if you're paying premium. Because look at the loan balance. Over here in 20 years, paying premium, the loan balance is $72,000. On the other one, it's $39,000. Okay. And I just arbitrarily used $1,000. Typically, what I do when I see these and work on them, I use the outlay to be equal to the outlay that the client is currently paying, which is premium plus loan interest. Okay, don't forget the loan interest.
So when the policyholder makes the $1,000 payment to, in this case, to Nationwide, they have to indicate that they want that $1,000 to go toward loan repayment.
That is correct. You can also set them up on an automatic loan repayment, just like you do a monthly bank draft on premium.
Okay,
Yeah.
that's more convenient. Yeah.
Yeah, I didn't get that technical on the illustration. I tried to make it easy for myself. So again, to me, part of what my goal is in these lunch and learns is to challenge your thinking on some concepts, bring you some ideas, and if you can use them, great. And if you have questions, I'm always available. If you want me on a call with your clients, I'm available. Doesn't cost you any of your commission. So I'm happy to get on calls and help you close business. Now,
Ralph, I was interested in the concept you presented a couple months ago about like $5,000 or $10,000 single pay annuities and grandparents with grandkids.
yes,
Because I thought, that's a great idea, and I've got a couple of family members with like 6 grandkids.
yep.
So I just wanted to know, and you said some companies, the lowest is a minimum of 5,000, some the lowest is 10, but I don't remember who those companies were, the names of the companies.
Well, Dustin, I kind of opened up a can of worms with that because we actually did that we did some with Jackson National because they have a $5,000 minimum.
Yeah, right.
And it's kind of been a nightmare because the kids and grandkids are scattered around the country, and the
Okay.
agent wasn't licensed in all the states. So it really kind of became an issue.
Oh, the agents weren't licensed in all the states.
Yeah,
Okay.
yeah, yeah. But that was with Jackson. That was with Jackson. There, and I can't remember because this agent just wanted to name brand companies. And there's another company out there that goes down to 5,000. And I apologize, I can't remember now. But that once you get to 10, 10 is a lot better. And the monthly income at 10, the income ratio is much higher than if you use the 5,000 to 999 band. So if
Yeah.
you talk them into 10 each,
Yeah.
they get a lot more money. But that we can go over that on another call sometime in the future
Okay.
because I myself I presented 3 times and got 2 that are about to close. So
Sure.
one had 6 grandkids and the other had 3. So I mean, just for asking, that was $90,000 of annuity money. So that wasn't bad for
Not
you know
bad.
5-minute question. All right. Who else has questions? Well, again, I thank everybody for your time. I hope you found it interesting and got some ideas out of it. I really like the mech idea with because those prospects are fairly easy to find, and I don't think you're going to have a lot of competition with them. Okay, and it's a pretty nice sale when you make it. You'll probably find some corporations out there that have million plus on the books. All right. Guys,
Thank you.
thanks a lot. Everybody have a
See ya.
great day and good luck to you.
Thank you.
Bye.
Thank you, Ralph.
Thank you.